This is Andre Banks coming today from Banks Credit Chat, discussing income and debt to income ratio. Now, lenders are becoming very strict in terms of how they're going about their practices in terms of lending. And when I'm saying strict, they're really just functioning by sound business principles. And days where you were once be able to get a slide with this, having a higher debt to income ratio is becoming less and less seen, especially in terms of the lending practices. If you want to get it pre-approved, you want to get that debt to income ratio down. Now, they look between 36 and 43%. That's a little, they're getting to the point where that's becoming a little too high. You want to get that debt to income ratio down to about 35%. Under that 36 to 43% ratio, threshold, I should say. 43% is, though it seems like it's manageable in terms of all of your, and essentially people who are not aware of it, your debt to income ratio is the number of debts you have out divided by all your debts outstanding divided by your gross monthly income. And if you have that around 43%, before they would allow that to slide, but a lot of lenders becoming, especially as the banks are having a lot of trouble in terms of repos and a number of different issues, they're really paying attention to that debt to income ratio and your income as well. And can you sustain that debt, and are you a credit risk? So 43% was considered to be manageable, but now I'm seeing people get rejected at that 43% ratio. Even at 36%, they start really testing the waters. And this is even if you have a decent credit score. So you really need to pay more attention to your income and your debt to income ratio. Try to get that ratio, that debt to income ratio, under 30, honestly, as low as you possibly can. So it's a good idea to start paying down your debt and not taking on new debt at this time. And I know that's an easy thing, easier said than done, because we live in a time and age where things are a lot more expensive. Inflation is just rampant. But just know that standards that was once possible just a year or two ago are actually changed dramatically. The banks are becoming much more careful about how they're going about things, and they're using really sound business practices. I did in a video in the past that credit was just not, we've gotten so comfortable having it that we didn't realize that it's still a privilege to be done. And even though the whole world functions on debt, how you're going to be able to service it is becoming much more an issue. And lenders are taking much more of a heed and really paying attention to your debt to income ratio. If it's at 43%, try to get that down, start paying your debts down. Look to get it under 36 if you can. If this video has been any value to you, please subscribe, leave some comments. Until next video for Banks Credit Chat, I'm out.